friends, this is ACC Amit Kumar and I'll discuss with you IAS 33 earnings per share. I plan to discuss the disclosure standards today with you: IAS 33, IAS 24, IFRS 8, IFRS 1. So we'll begin with IAS 33 first. So IAS 33 is the standard for dealing with earnings per share. So we'll have a look at how to calculate the weighted average number of shares for EPS calculation, how to deal with bonus issue and adjust it for the previous year, how to deal with the rights issue, and according to the standard on EPS, it requires that we need to present not only the basic EPS, we also need to present diluted EPS with equal prominence. Diluted EPS means we project what if all the potential ordinary shares get converted, what will be the impact of it. Potential means the shares which has the potential to get converted into ordinary shares. The earnings per share is calculated for ordinary shareholders. Ordinary shareholders means the one who bears the highest risk. If I talk about game of chess, the people in the front line can be considered as ordinary shareholders. They bear the highest of risk. And they are the ones who has a right over net assets only on liquidation. They do not have any right to demand the money they have paid in the form of capital. They only have right to shares and may not have even dividend discretion rights. If the company declares dividend, they get it. If they don't, they may not. Now their wealth is dependent on how many shareholders own the net assets of that company. How many of them are the owners of that company? Now, if the company is falling short of cash, that year they may decide to issue a bonus issue of shares, that whosoever is holding 5 shares, they give in bonus 1 more share. They issue more number of shares. But that issuing of more number of shares is actually diluting the number of owners of net assets. If the number of owners of net assets increase, the earning per share decreases. So the investors may lose confidence in the companies if there is a probable dilution of their earnings, or even if there is a threat to their earnings. Now, to disclose this fact to them, it becomes really important that not only we'll present the basic EPS, that what is the situation today, what is the earning per share today. Now we'll present earnings per share today for continuing operations as well as for continuing plus discontinued operations. Basic EPS needs to be presented. Now we also need to make them aware that what is the potential threat to their earnings in future. Now this may seem irrational, but this will help them to take better decisions, that we assume what if their earnings get diluted, and how they can get diluted only if there is a chance that the potential ordinary shares, the shares which has the potential to get converted into ordinary shares, what if they get converted? Like there are convertible bonds or convertible debentures. If they get converted, what will happen? We were paying interest on them till now. If they get converted into ordinary shares, we'll stop paying interest. If we stop paying interest, it becomes an income for us. If it becomes an income for us, we are also liable to pay tax on it. So the income which we gain because of not paying that interest is net of taxes. Now in comparison to it, if we do not pay back this money and if we convert it into ordinary shares, in comparison to it, we were able to retain some income, earnings because of retaining this interest. But how many shares got increased because of this dilution? Now, if there is any dilutive effect of these transactions, we include them as part of diluted EPS. Now, since IFRS is conservative in approach, we only include dilutive circumstances in EPS calculation, in diluted EPS calculation actually. we do not include anti-dilutive circumstances. Anti-dilutive means which improves the earnings per share. That if these shares get converted into ordinary shares, instead of decreasing the earnings per share, they are actually helping in increasing the earnings per share. This is a good sign for the company. So in diluted EPS calculation, we do not include anti-dilutive circumstances. We only include diluted circumstances. Anti-dilutive circumstances not included. Now for diluted EPS, we need to calculate new earnings and new number of shares. This is what we plan to study in this standard. Let's have a look at it one by one. We look at earnings per share, the key definitions of EPS, basic EPS, weighted average number of ordinary shares. EPS when there is a bonus issue, how to deal with it, rights issue, diluted EPS, new earnings, new weighted average number of shares, anti-dilutive circumstances, and dealing with share options. So EPS is a measurement of the amount of profit which is owned by ordinary shareholders, and it is after tax and preferred dividends. That after we have paid to the government our tax liability, and after we have paid to the preference shareholders their dividend, what they were eligible to receive, whatever is remaining is the earning belonging to the ordinary shareholders. We divide it with the number of weighted average number of shares outstanding at the end of the year, because these are the people who can claim on the earnings. We calculate basic EPS. The ordinary share is an instrument that is subordinate to all other classes. As I said in the game of chess, the first line, you can consider it as ordinary shareholders. Potential ordinary share, a financial instrument or other contract, financial instrument like a bond or a debenture or a convertible share can help them to get converted into ordinary shares, share warrants or options. The financial instrument is any contract which is an asset of one entity and liability of another entity, and it has to be a contract between two parties to settle. Now, if you remember, there was a quote that we can settle in entities' own equity instruments. So if there is a clause wherein entity issues their own shares to settle liability, that increases the number of shares, and if the number of shares increase, they dilute the earnings of the ordinary shareholders. Equity instrument is any evidence which gives residual interest. That if on liquidation, if the company gets liquidated, and if we sell off all the assets on a particular day, is the reason we try to know the position of the company on a particular day, that is as on date the balance sheet was this. Now if the company gets liquidated on that particular day, if we sell off all the assets and if we pay off all the liabilities, what is the residual interest? Is the equity element belonging to the ordinary shareholders. They can stake claim on that amount, the residual interest, what belongs to ordinary shareholders. Now the profits of the company are also to be divided among ordinary shareholders. So we try to know what is the profit left after paying taxes and after paying preferred dividends. What is the earnings per share, which is a performance measure actually. So it helps investors to take better informed decisions. So basic EPS we calculate by net profit or loss attributable to ordinary shareholders. We divide it with the weighted average number of shares outstanding, and we will present basic EPS with equal prominence, as I said, not only for continuing operations, but also for continuing plus discontinued operations. We'll discuss an example on what is weighted average. So number of ordinary shares will be the weighted average number of ordinary shares outstanding during the period. The number in existence at the beginning of the period should be adjusted that have been issued for consideration. What it really means is that if there were 100,000 shares in issue at the beginning of the year, and after 3 months, if they issue 20,000 more shares, what will happen? Will the company receive more money? And if the company receives more money, there are chances that the earnings will increase. So we take the average of the shares, that 1 lakh shares were in existence for 3 months, but it became 120,000 after 3 months. That means our earnings potential or our ability to generate earnings increased after 3 months because we received more funds by issuing those shares. If you again issue in October, our ability to increase earnings increases more. If we buy back, the number of shares outstanding reduces because we pay cash outside the company and we buy back our own shares, that is treasury shares. When we enter into treasury transactions, we're actually buying back our own shares. We reduce the number of shares outstanding. The number of shares outstanding or weighted average number of shares outstanding becomes an important figure to be used as denominator for calculating basic EPS calculation. Let's have a look at it. If 100,000 shares are issued, after 3 months 20,000 more shares are issued, and after 3 months 15,000 more shares are issued. This is the position at the beginning of the year on 1st January. On 1st July, this is the situation on 1st October, and the financial year ends on 31st December. Can you tell me the weighted average number of shares outstanding during the period? We have choice that 100,000 was available for the entire 12 months. 20,000 was in existence for 9 months, and this 15,000 was in existence for 3 months. This was for 6 months actually. The other option available to us is that we can say that 100,000 were in existence for the first 6 months. Then it turned out that it became 120,000 for the next 3 months, and it became 135,000 for the next 3 months. Now mathematics is a choice. Whatever method of mathematics you plan to use, you're free to use. You can use this method of mathematics, you can use this method of mathematics. The result will be the same. 100,000 were in existence for full 10 months. 20,000 for 6 months, that means 10,000, and 15,000 for 3 months, 3750. The weighted average number of shares outstanding for the year equals to 100,000 plus 10 plus 3. Now, instead of directly saying that 135,000 were shares in issue, we relate it to the period how these shares have been issued, because when they are issued, there's a cash flow coming in, and if cash flow comes in, the company's ability to generate profits increases, or their ability to generate profits increase. So we are directly relating it to the cash flow coming in, because that's the concept on which the EPS calculations are based. The concept of bonus issue and rights issue is based on the simple logic that if cash comes in, a company's ability to generate income increases. If cash doesn't come in and there's a bonus issue, the company's ability remains the same, but the same earnings get divided among more number of people now. So this is based on this logic. 100,000 was in existence for the first 6 months, 120 in existence for the next 3 months, and 135 in existence for the last 3 months. If there is a treasury stock, the number of shares reduces. In whichever month it reduces, we simply need to take that into account, that they were in existence for this period. So mathematics, as I said, is a choice. You can use any of the way to use your mathematics. You can use this way of arriving at weighted average number of shares, or you can use this way, whichever way you're comfortable. So our job in this case was to to calculate the denominator. Denominator is weighted average number of shares. Average number of shares outstanding during the period. Now, this is a requirement that we need to calculate the weighted average number of shares, and this will be used as a denominator for calculating basic EPS calculation. The numerator is profit after tax and after preferred dividends if they exist, and that becomes the numerator. If we use this numerator and denominator as calculated now, we get the basic EPS. Profit after tax and preferred dividends divided by weighted average number of shares outstanding during the period. I'm not writing the complete sentence, but that's what I mean. So as we progress, as I said, instead of cash, if company declares a bonus issue, for every 4 shares, the entity issues 1 bonus share. Now, what will be the impact? If 100,000 shares are in issue as of today, bonus issue will be equivalent to, for every 4 share, 1 share. That is equal to 25,000 shares. The total number of shares reaches 125,000. Now, as I said, bonus issue comes in without any resources. So the earnings remain the same. There is no impact on the earnings. IAS 1 says that if you're presenting your current year EPS, there is a requirement for presenting your comparative EPS as well. Now, last year, when we presented our EPS, it was on the basis of 100,000 shares. But this year, if you present our EPS, it will be on the basis of 125,000 shares. But the resources are same as they were last year. Can we compare the previous year EPS based on 100,000 shares and this year EPS based on 125,000 shares when there is no change in resources? So there is an assumption used for this, for the purpose of comparison. Assume the bonus issue has taken place at the beginning of the previous year. If you assume this, the bonus issue has taken place at the beginning of this year, if previous year earnings were 400,000 and number of shares outstanding were 100,000, we'll still assume that the previous year earnings will divide with 125,000, assuming that the bonus issue has taken place at the beginning of the previous year. So previous year EPS will be adjusted again. The same earnings will be divided with this year's EPS to make it comparable, because current year earnings may be equivalent to 500,000, and number of shares, now since we are assuming that it has taken place at the beginning of the previous year, obviously this year will take 125,000 as the number of shares in the form of denominator. This is how bonus issue is dealt with an assumption for comparison that the bonus issue has taken place at the beginning of the previous year. Since they are coming in without resources, so there is no change.